Hello options traders, Steve Ganz here, and I want to walk through one of the start to finish trades that just wrapped up and kind of give a play-by-play, if you will, as that trade unfurled. So this is going to be a trade that expired on 2/16, and it was a short-term SPY trade. So let me kind of walk you through how this trade progressed. So the first thing was that on February 13th, we had a gap down in our market. Each one of these candles, by the way, represents 4 hours of time. But our market gapped down that morning on a CPI number, and it gapped down to an area that had previously been resistance. Many times when there is resistance in the market and you pull back to that, that will end up being support. So volatility ended up spiking off of this CPI number, meaning that options prices become inflated. Specifically, put prices become inflated because there's some fear in the market and people start going out and buying those puts for insurance. So when you have something like that occurs, when you have a news report of some type and the market, sells off down to what might be a support area, that's when I usually want to try to sell something. So I'm looking at what can I do here? What can I sell into this fear? Well, in this particular case, I sold this $4.95 put. I sold it for $2.27. Now I did this was on a Tuesday, as I recall, and this option expired on the 16th, only a few days away. So this was designed to be a short-term trade because I was expecting that this fear in the market, since we're in such a bullish trend right now, was also going to be a short-term fear. So I sold that $4.95 for $2.27, but I didn't want unlimited risk. If I just sold that put, I have unlimited risk if SPY continued to go down. So I wanted to do something else to protect myself, and that is buy the $4.90 put, and I paid 80 cents for that. So that gives me a potential net profit. And if I sold something at $2.27 and then I bought my own insurance or my own protection at 80 cents, basically I took in a net amount of $1.47. So that is my potential profit, that $147 that you see here illustrated on OptionStrat. Now, I also have risk in this trade. Well, the spread risk is the $5 wide spread. So I sold the $4.95, I bought the $4.90, that's $5 wide, and I took in the $1.47. Again, I have a risk of $5. The difference between those two is the $3.53 or $353 in max risk. So that trade was all fine and good. I put that on. My expectation was that the market was likely going to bounce after that CPI number and after there was that initial fear and sell-off. And in fact, that is what happened. Our market had sold off to here. It actually sold off a little more during the day. So that trade was actually losing a little bit of money at one point during the trade. And I could have potentially gotten a much better entry had I waited for part of that sell-off to occur. But anyhow, I anticipated that this was going to be support, and it was. The market started rallying up from there over the next couple days. So then the market rebounded back to all-time highs a couple days later. So when I look at that, my next question is it time to sell something else? Can I sell something else against that put spread that was highly profitable at that point? It hadn't achieved its max profit because there was still time left in the trade, but it was getting close to its max profit. But because my vision here was when we got back up to here that this all-time resistance was likely going to remain in place, I chose to, in this case, sell a 501 call for $1.01. But again, I didn't want unlimited upside risk, so I needed to buy myself some protection, and I chose to buy the 503 call for 48 cents. Now, notice that the combination of these two gives me a potential net profit on this particular spread of 53 cents. But more than that, I want you to notice this diagram. This is essentially an iron condor because I sold a call spread on one side, I sold a put spread on the other side. But because the spread widths here are different, you can see that I did this side in a way that I have zero upside risk in this trade. If the market were to rip up forever here and break through to all-time highs, yes, I will give back some of the profit that I currently had in that trade, but at least I'm not increasing or I'm not taking on any upside risk. I would end up with a net of zero if the market ripped up. But again, my premise was we were going to get a little bit of a pullback. So now the spread risk is my $2 wide strikes here less the 53 cents taken in. Now remember, previously I had a total risk of $353. That's what my max loss was. But because I took in an extra 53 cents in selling this spread, my max risk now is a total of $3. Basically, I reduced my cost basis or my risk in this trade by an additional 53 cents by selling that call spread. Now, the market did cooperate in this whole deal, and the market basically fell back off on Friday at expiration. It fell down to 499.57. So what that means in this case is that this spread expired worthless, allowing me to capture the full value that I had in that spread. This spread also expired worthless, or some people will say out of the money, and allowed me to capture the full amount of this spread. Remember, this one was $1.47. This one was 53 cents. That adds up to essentially the $2 or $201. In this case, it probably was just a little rounding based off the pennies there. So anyhow, that's kind of the anatomy of a short-term SPY trade that was played on both sides using technical analysis. And hopefully you found this informative. If so, please, please, please always give me some comments, a like, a subscribe. I greatly appreciate that. And I'll continue to provide more content like this. Thanks so much, everyone. Take care.